Good morning, everybody, and welcome to the Siler Wealth Management video stock market blog. And today is Monday, October 12th, and we're coming off just an absolute terrific week for stocks. And let's go back and play the tape, folks. When I talked about having some problems and some struggles with the market in August, September, not a great month, but markets do typically bottom. Although the markets are still down for the year, we have recovered quite a bit. And last week, the major averages, the S&P 500 up about 3.3%, the NASDAQ up 2.6%, the Dow is 3.7%. It was some crazy numbers. And energy stocks up 8% on the week. And we talked about it bottoming. I did that piece last week comparing gas to water or Red Bull. And so things are looking really, really good right now in the bottoming process, okay? I do suspect we're going to have a retest. Volatility is going to continue for a little bit. You still have a lot going on. The government potential shutdown in December. You have a Fed meeting. I don't believe that the employment report that really disappointed last week, or actually 2 weeks ago now, is that big of a deal because we still added 142,000 jobs. And according to economists, if we add 100,000 jobs a month, we will stay at almost full employment. 5.1% is pretty much full employment, almost, for all intents and purposes. Okay, now what I want to do is I want to talk about real quick, and I talk to people. We've been seeing a lot of clients and a lot of prospects coming off of this video. They come in the office and say, so what do you hold? I said, a mutual fund. Okay, what type? I'm just a mutual fund. Okay, I just want to make sure that everybody understands. There are thousands and thousands of different types of mutual funds. Let me just describe you, and I'm going to also describe ETF, an exchange-traded fund, because they're very similar. But let's start first with a mutual fund. Mutual funds are investment vehicles that most people have owned in the past. If you're an investor, you've owned a mutual fund, and you probably own it in your 401k. Sorry, I need some caffeine. So, you own it in your 401k, and basically a mutual fund is a basket of securities. When I say securities, yes, a mutual fund could be a basket of stocks, could be a basket of bonds, could be a basket of gold stocks, could be oil. It's a basket of securities. So what the key with a mutual fund is, you're trying to get diversification by owning a bunch of different securities. Let's just start with the stock fund. But of course, when it comes to stock funds, you could do large cap, small cap, medium cap, blended, grow the value. So it goes on and on. That's why you need an advisor to help you. And by the way, we do help on the 401k selection, and that's a free of charge service too. If you need help with your 401k and allocation, let us know. We'll go over for you and try and get you in the best allocation you can based on your risk tolerance. Okay. So a mutual fund. All right. Here are the advantages. You can buy one investment, which is a mutual fund, and already have some diversification because you own 100 securities or 200 securities, depending on how large the fund is. The other advantage is that you have a manager managing it for you, so they'll buy and sell within that mutual fund. Okay. Disadvantages, there are a few disadvantages to them as well. And we use no-load mutual funds. Now, when I say no-load, there's no commission attached to them. There's some firms out there still sell loaded funds, which means there's a commission on top of it. Hey, I don't begrudge a commission, okay? My point is, we could do no-load funds. Let's try and do those. So, on these no-load funds, keep in mind, they trade only, all the securities within the fund trade all day long, but you can only execute the transaction at the end of the day after the close. So if you put a buy order in a mutual fund at 10 o'clock, just after the market's open, and the market was only up 20 points, and by the end of the day, it's up 500 points, you're going to get the higher price. They're going to execute at the end of the day. That's a disadvantage. The other disadvantage to a mutual fund is if it's in a taxable account, this is not applicable if it's in an IRA, 401k, or any kind of tax advantage account. But if it's in an individual account, you can get hit for capital gains taxes and not have good performance in your fund. Because what happens is, all that buying and selling they do in this umbrella, they buy, they sell, they buy, they sell, there are tax consequences involved. And at the end of the year, typically in December, you will get a distribution. Everybody goes, wow, I'm getting a distribution. That's great. Okay, doesn't mean the fund is up. So let's say they have 10 stocks. All the stocks in his portfolio are down for the year except for one. He had Apple, and he's owned Apple for 11 months, and he made 40% on it. He's selling it. But everything else is down. So let's say you bought that fund 3 months ago. The fund is down 10%, but at the end of the year, you're going to get a capital gain for that Apple stock he sold. And you're going to have to pay taxes on a fund that is down. That's a disadvantage. Now, exchange-traded funds really came into dominance in the mid-90s, and then really have really hit dominance now because there are more assets flowing into exchange-traded funds than there are mutual funds. Exchange-traded fund is a hybrid between a stock and a mutual fund. So it's a security that has everything underneath it. It's an umbrella with all kinds of assets. Could be stocks, bonds, gold, energy stocks, whatever the case may be, or combinations thereof, but they trade like a stock. So that example I use, if you bought an exchange-traded fund at 10 a.m., guess what? You get a price at 10 a.m., and you can sell it later if you want. So there's more liquidity, meaning you can sell and buy throughout the day. There are no capital gains problems when it comes to worrying about that at the end of the year, you get a capital gains because you own it like a stock. So if you bought it at 20, you sell it at 22, guess what? You're going to pay taxes on those $2. They do pay dividends, and you can produce income from them. The flexibility, I think, are greater on exchange-traded funds, no question about it. So we use a combination of both, and those are they're staples in our portfolios because we use individual stocks, we use individual bonds, we use exchange-traded funds, no-load mutual funds, and then alternatives. We'll be talking about that tomorrow at my event. However, I have bad news. I have no more room. Anybody that we've said, yes, you're in. I have no more room for my event tomorrow at Café Murano, but I'm going to start doing more events as time goes on. All right, we're going to try and do one a month and get some people in there and do maybe Investing 101. I have a Women in Investing presentation I want to do. I'm not going to give a cruise out today. I'm going to do it on Wednesday. All right, we don't have a lot of time for that because I want to go into real quick one other thing. I want to go into something in the things that make you go, category. In watching President Obama last night on 60 Minutes, and they were talking about the Hillary Clinton email scandal, he said, yes, it was a mistake for Hillary to do personal emails through her server or government-sensitive emails through her server. And he said, yes, that was a mistake. But he also said that there was no threat to national security. So I find that a little bit interesting because the FBI has not concluded their investigation yet. But it seems like President Obama is already the judge and jury and not an executioner at this point. So let's keep a close eye on what's going on there because we have a woman that could be the President of the United States or she could be